that there is a financial return as a reward of that. And I see it very often where that's not the case, unfortunately, and sometimes team members are earning more money than the business owner. So really passionate about changing that and helping business owners better understand and manage their finances, and particularly profitability, and understanding how their business actually makes profit and their own unique business model and profit model, and then how do we work on that to improve it and optimize it. So that's what we ideally want to try and cover today. And again, hopefully there's lots of value in there, and ideally a couple of key takeaways for each of you to walk away with. So we'll get into it. There's quite a bit of content, so we'll go through it reasonably quickly. Jen will keep an eye on the chat. So if you do have any questions as we go, put them in the chat. And if there's anything relevant that pops up, Jen can flag and let us know. Otherwise, we will have a question and answer part at the end of the session as well. So let's jump into it. So I'll just share my screen, and hopefully you can now see the presentation. Yep, great. Okay, so today is all about profitability, as we spoke about. So we'll be digging into 7 ways to improve profitability in 2021. So this is a slide, and really just one to provoke some thought. If this is something that you feel when you log into your computer, open up your bank account and see the balance in there, or run a profit and loss in Xero and see that it's not looking like you want it to, that's obviously the purpose of today. How do we change that, and what can we do in our business to turn that around and improve it? So 3 parts to what we'll work through today. Firstly, just want to cover off some key principles around profit and why we really need to make it a focus in our business and a priority, and putting it first, essentially, and not just letting it drop out as an end result of our activity. Then we'll drill into 7 ways, 7 strategies to work on improving profitability. And then we'll wrap up at the end with hopefully some takeaways for everybody, including some question and answer time. Okay, so we'll jump into key principles of why you put profit first. A few of you may have seen this quote. It's been around for a little while. I'm not sure who originally started it, but it's always a good reminder that revenue is vanity, profit is sanity, and cash is reality. So in that order, we just need to be mindful. And today, really, we're focusing on the middle part, and hopefully cash then drops out of it. Cash flow is a separate discussion, really, but this is really all around profitability and getting that right, and making sure that if we are selling, that we're selling profitably. This is a quote from Mike Michalowicz, who's the author of Profit First. So some of you would have heard of or read the book written by Mike called Profit First, and it's a system that he's developed around putting profit first in your business. So it's a bit of a mindset, well, a big part of it's mindset, behavioral change, and then implementing that and forcing change the way you run your business, and particularly from a cash management point of view. So one of the quotes out of the book is that profit is not an event, it's a habit. So it's something that you need to ingrain into your business on a daily basis that then results in profit. It's not something that will just happen and fall out at the end of a month or the end of the year. It's something that you've got to ingrain into your business, into your mindset as the business owner, and then obviously and ideally filter that into the team and into the culture in terms of what you do, and making sure that whatever you're doing, it's profitable. So putting profit first, again, just re-emphasizing the importance of it. A recent stat that I came across was that 40% of small business owners, only 40% are turning a profit. So that's when you factor in a commercial owner salary for the business owner. Once you factor that in, 60% aren't turning a profit in that scenario. So really want to try and turn that around and increase that number, really, to make sure, again, that the financial return is there for the effort that's put in. So from a mindset point of view, putting profit first creates that focus, and naturally what we focus on, we put first in our business, and just really want to make sure that the business model that we've got is profitable. And I've seen that a number of times where people go into business and they have a great product or great service or great idea, and they deliver a great service or product, but it doesn't provide the financial result. It doesn't provide the profitability that it should. And that comes down to your profit model or your business model, and really understanding how your business actually makes money. And sometimes the business itself, it's either the wrong model or it's in an industry where it is very, very tough to make money, and you've got to operate in a certain way to be profitable. And really it's around profitability rather than sales. So very often there's a focus on sales and generating revenue, sell, but we need to be mindful that whatever we're selling does need to be profitable. And then hoping profit will come later really is a fallacy, and it's a bit of a Silicon Valley thing that pump a lot of money in and profit will come eventually. But in 99.9% of businesses, you've got to have it right from the start and understand your profit model so that it's always there. And as you grow, you are growing profitably as well. So moving on, so we'll dig into some 8 key principles around profit, and these are a mix of general principles as well as some of the key principles that are out of the Profit First book. So we've kind of covered on this. Really, it's the primacy effect and the mentality around putting profit first in your business and making profit the focus, not sales. And in terms of profit first, and the system there is really around essentially putting away profit before anything else and then working with what's left. That's the basic methodology. Also applies to going way back to the richest man in Babylon, where it was about putting 10% of your earnings aside and saving 10%. So similar sort of principles that we're working from there. So the second principle is really how it actually works. So from a envelope system bucket strategy perspective, this can be really effective for certain types of businesses, not always applicable and not always it will help or change your business, but certain types of businesses it will really help with, firstly, cash management, but secondly, changing behavior. So this is particularly relevant for individuals who are more a spender rather than a saver type mindset. If they get a lot of money into their business, it tends to then just go straight back out. So this sort of strategy where you're physically moving money to different bank accounts and for a set purpose and then not touching it can work really well. And then you're only left with what's left in the expense account to then spend. So it's that old strategy around envelopes. And I know my nan, when she got her pension, would use the envelope system to put it away for mortgage payments and other things. So same principle there. And those percentages there, I've got some examples where you might have a couple of different accounts where as soon as money comes in, you allocate percentages directly to those accounts and then work within your means and forces behavioural change as a result. So that can be quite effective for certain businesses. The next one is, again, around behaviour and behavioural psychology, and really that, and the old toothpaste analogy, that squeezing out what you've got in the toothpaste jar works the same in terms of cash, and whatever you're left with, you'll make do and squeeze as much as you can from it. So Parkinson's law says that expenses will match to grow your income, and the same with filling time. If you give somebody a week to do a project, they'll typically take a week. If you give them the same project to do in a day, they'll probably do it in a day or close to. It's just that principle of putting some time around it, some boundaries to force change. And that's really what it is there from a principle perspective. Another one which is really important is allowing for owner salary in the business. And I see that very often where the owner isn't taking a salary or isn't taking a drawing. Now, from a tax perspective, you may not actually take it as a salary or wage, because that may not suit. But I would suggest that there is actually a physical payment of some sort, whether it's treated as a drawing or a dividend or a wage or salary. And comes out on a regular basis, whether that's weekly, fortnightly or monthly, so that it then becomes a real expense, a cash expense in the business. And then anything above that, then becomes profit. Otherwise, it just all gets mixed in and you get to the end of the year and there's nothing left in terms of owner salary. And then linking in with that personal budgeting, that really does tie in as well. So, and treating your business and your personal affairs separately is really important. And I've seen that where some business owners just mix the two. They treat the business as their own. They pay expenses, they draw as and when they want things. And it really doesn't create any financial discipline doing that. So you really want to have that financial discipline in having that clear separation between business and personal. And whatever you take as a owner salary or drawing, ideally then be living off that, and do your personal budgeting around that, rather than relying on the business and drawing from the business when there's available cash and then having problems down the track. So again, a personal discipline thing there. The next one is really around being lean in terms of expenses. And it's the analogy with plate size and dieting and food, for example. And studies have shown that if you simply serve up or use smaller plates, you will typically consume less, and that can obviously contribute to losing weight. So same sort of thing in terms of expenditure, having less available in terms of cash in the bank to then force your behavioural change in terms of what you spend. And if expenses are going out each month, it'll force you to look at them and say, do we really need this, or can we look at another option or another supplier? And just being really tight on monitoring expenses. And that's something that can, particularly if you're in a growth phase, that's something that can grow quite quickly. And if you don't pay attention to it, you end up with quite a high level of fixed overheads, software subscriptions and other things that can build up and accumulate, which are unnecessary. So that's another principle as well that really should be regularly visited. And I'll talk about that a little bit more later in terms of expense management. The next one is really around building a schedule and a rhythm. And this is really key in financial management, in putting time aside to spend on your finances. And some people are better at this than others, but if finances aren't your strength and you're good at what you do, or you're good at marketing in the business or sales or whatever it might be, you tend to put finances to the bottom of the table and it never gets done. But actually blocking out time and making it a priority is really important, and having a schedule and a rhythm around your financial management, and whether that's weekly or fortnightly, blocking out half an hour, 2 hours, whatever might be relevant in your business to then be managing your finances actively. This is another one in terms of reward yourself. So making sure that you've got some motivation there to hit your targets. So when I spoke about taking an owner salary and not additional drawings, and sticking to that, you can have a profit distribution, maybe on a monthly or a quarterly or semi-annual basis, but have some rewards attached to that. That if you do hit that, then you will reward yourself and provide some motivation there. And that's really around goal setting and rewards there. And then the last principle, just to cover off quickly, is around debt. And debt can be really crippling in business if it's not managed well and handled well. So one of the key principles is about getting rid of debt and paying down debt by being profitable. And there's different strategies in terms of managing your debt depending on the type of debt you've got and how expensive the debt is. But again, from a mindset thing, if it's something that you've constantly had in your business, you're constantly carrying debt, you're constantly behind with the tax office, you're constantly running at an overdraft or at a credit card limit, this is one that you really want to pay some attention to and get rid of your debt and change your behavior in the way you use your debt and get more enjoyment out of saving than spending in this scenario. And this is just a quick example of the potential with making some of these changes and being really disciplined. And this client particularly did really well in turning their business around. They had almost a $3 million business, doing about 2.9 million in revenue, but they also had expenses at that level. So they were making no money and they were in that position for a couple of years. So they really wanted to make a change. They were working hard. So they implemented, not fully, but some of the principles out of Profit First, which we've just covered, in reviewing their model, reviewing their expenses. The first year, you can see there was quite a dip in revenue. They went back to 2.4 million in revenue, and their expenses only dropped 100,000. And in their case, they had a number of premises and leases in place and a number of team members that they restructured and made some redundancies. So it was quite costly that first year to make the changes. So they actually went backwards before going forwards, and they made a loss in that year of 400. But then coming out of that, they turned around, they picked their revenue back up to 2.6, but they've brought their expenses further down to 2.1, and they've been able to maintain that since. So they're now doing around a 500K profit a year since implementing this and making these changes. So that just shows the potential of good financial active management. So there's some overall principles. So we'll dive into some strategies in how do we actually look at improving profitability. So the first big one, which I very often see and ask business owners, do they know the answer to this question? And it's very often no. They don't know their gross profit or their margin, and also the difference between markup. Some of you may be involved in industries where markup is used on products or services. Some may not, but there is a difference between the two as well. So understanding that. So that's the first one, which we'll drill into. And correctly calculating it. So I've seen some businesses that do it, but the numbers are wrong and they're not correctly calculating their margin or their gross profit. So just to understand what it actually is, and this should be done, if you look at your profit and loss, if you run your profit and loss and you just see income and then a list of expenses, that means you're not doing this and you're not properly separating out your cost of sales. We need to separate out our cost of sales to be able to work out our gross profit. So this is number one on your list. If you're not already doing it, split out your cost of sales in your chart of accounts and in your profit and loss statement, which we need to be able to work out a gross profit figure. So cost of sales is basically anything that directly relates to generating revenue. So if you're a service business and you've got team members that deliver service, so such as our business, an accounting firm or law firm or whatever other service business, the individuals who deliver the service, the professional staff, accountants, lawyers, etc., their salaries and costs associated with them are our cost of sale. So their salaries go into your cost of sales account. And that should also include your owner's salary if you're involved in generating revenue. So if 50% of your time is on service delivery or client work, for example, 50% of your owner's salary, and that should be a commercial owner salary, not what you actually take. So commercial owner salary might be 100 grand for what you do if you were to employ somebody else. But you might only be taking 50 grand for tax purposes. It should be based on the 100 grand so that we have a true reflection of reality. So that's service-based businesses. Obviously products, it's anything directly related, costs associated with the product. So materials, supplies, actual product costs go into cost of sales. So that's a real key one. Anything that's not cost of sale, then it falls under overhead or fixed expenses typically, which then sit in your P&L below as overhead expenses, and they're there regardless of income. So if you don't have any income for the next month, 2 months, 3 months, those expenses are still there. You know, they're your fixed salaries, they're your rent, your mobile phone, internet, all of those things that are fixed regardless of level of income. So in terms of knowing your gross profit, that's at the high level. At a business level, knowing what your overall gross profit is. Ideally, we want to drill in deeper and we want to know gross profit at a product level, service level, division, location, job level. If you work on jobs or projects such as a builder, you know, they want to know their gross profit per project or per build, and even a client level. So knowing your gross profit per client. So this really comes down to your setup, your system, your accounting system, whether you use a project or job management system. You can do it in Excel. Obviously depends on the size, the scale, the volume, how much work there is to do it manually versus, you know, using a system to help with it. But this is a really critical one, which enables you and gives you probably the key piece of data in terms of profitability in your business, to be able to know what parts of the business are profitable and what aren't. So if you've got, say, 3 service lines, you want to know exactly what each service line, the profitability on each service line is. And if you're not splitting it out, if you're not splitting the revenue and the costs, so you would split it out and say service 1, and then you'd have to split out the cost of sales for service 1. That gives you your gross profit on service item 1, and then doing the same for each other service line. If you don't know what that is, then you don't know which service lines or which products or which divisions are profitable or not. And very often there's one that's carrying another one. Same with clients. If you've got a different array of clients that you work with, or even the same type of client, some clients are going to be more profitable than others. So you really want to know that, so that then that informs your marketing and who you target and who you go after and who you want to be working with and who you want to attract. So that's a big one, a key takeaway I'd suggest looking at if you're not already doing it. And then the question is, okay, I know what my gross profit is now. What does that mean? Is that good? Is that bad? Is that ugly? Is it indifferent? This is a bit of a guide. The answer is it does depend on your business and your industry and where you sit within your industry, but this is a bit of a guide in terms of range for different types of industries. So gross profit margin can range, as you can see there, from 80% down to 10%. It really depends on your business and your industry and where you sit within there. So, but as a guide, if you fall into one of those categories, then that's roughly where you should be sitting, and then ideally moving up towards the higher level is obviously where you want to be. Markup versus gross profit. So for those of you who are involved in markup, and that's builders, construction, and trades and other type of services where or retail where you mark up, you want to understand the difference. And very often it gets confused that it's the same thing, but it's actually not. You can see there that a 20% margin actually equates to a 25% markup. And I've got a working example in there, which sort of works it through. But the reason being is margin is worked out on a higher base than markup, essentially. So if we work through this quickly, if you've got a job that costs you $100,000 in cost of sales, your markup's 25%. Therefore, your price is $125,000 for that job. Your profit on that job is $25,000. So your margin is actually 20% because you've made $25,000 out of the $125,000 as profit, whereas your markup was actually 25. So key difference there to understand and be aware of if that's relevant for you. And just wanted to show this. Hopefully you can read this. It might be a little bit small, but just show the impact of gross profit and margin on your business. And I'll quickly work through this. In this instance, we've got a desired profit target of 250,000. So that's what we've set as, that's the profit figure we want to aim for. We then work out what are our fixed costs. In this scenario, they're 400,000, and that's including an owner's salary. And then that's the breakup down there of our fixed costs. Therefore, you add those together to work out what gross profit is required to achieve a desired profit of 250K. Then if we look at margin, so this is our margin or our gross profit percentage. This shows you the substantial difference in margin in terms of what's required from a sales perspective. So for that level of profit, if you're working on a 10% margin, you've got to do 6.5 million in turnover to achieve that level of profit. Whereas if you're working on a 25% margin, you've got to do 2.6 million in turnover. So this really just highlights the importance of margin and how critical it is in your business and how much of a difference it can make. So again, rolling on, this is sort of another example, and this is specifically for a builder, and it also looks at conversion as well in, so looking at different profit levels, what gross profits required, what the difference between, in this instance, a 15 and a 20% margin would be, and what number of projects would you have to be going after, how many leads would you need. So I won't spend much time on that, but just another quick example to show again the impact of margin. So the next strategy to have a look at is really around setting a profit goal. So this is around budgeting and actually sitting down at the start of a period, typically at the start of the year, and saying, what do we want to achieve this year from a profit point of view? And again, a lot of business owners don't do this. They just don't have a budget or a target that they're aiming for, and they might have it in their head, but that's the extent of it. So that's what we're really talking about here, having a profit goal. So what do we need to look at and consider? We've kind of covered off on this. You've got to understand your fixed costs, your overhead costs that are there, as opposed to your variable costs, which go up and down in terms of revenue. So firstly, understanding that. Then allowing for owner salary and budgeting, which again, we've covered off, but making sure that's covered as part of your budgeting process is really important. So I think we've largely covered that. Reviewing your expenses, so as part of your budgeting process, going down line by line and actually spending the time to see what can be done. And here's a few strategies in terms of, well, what do we do in terms of more effectively managing and reducing our expenses? So have a look, is there a free option instead of a paid option? Do we need to buy new if it's equipment, or can used suffice? Obviously avoid paying full price. A lot of this is negotiation skill and talking to your suppliers. around negotiating better deals, sourcing other options to reduce wherever you can. Delaying major purchases. Always ask the question, do we really need this now? It might be a nice to have, but it's going to affect our profitability. Do we need it, or can we make do for the next 6 months or a year? So a couple of considerations there. And this is an example of a 12-month budget. I know, again, it's probably pretty small for you to see on the screen, but this is the long and short of what it is. It's essentially a spreadsheet with 12 months listed. We'd usually do financial year with a total for the year, and you've got your income, and you might have it by sales or service line. Then you've got your cost of sales, which then shows you your gross profit that you're targeting. And then you've got your expenditure listed out, and your gross and your net profit at the bottom. So in this case, if you look at the far right column, and all these figures are GST exclusive, which is highlighted up the top. On the far right column, and I'm just seeing actually whether I can use a laser pointer. Let's try this. I haven't used it before. Can you see that? Yep. Okay, that's cool. I was just moving my mouse and realized you wouldn't be able to see that. So you can see the last column here is the total for the year. So in this instance, we're budgeting, well, actually, we've got last year's figure. So this business did $1 million in revenue last year. We've got a figure here. We're aiming for a 10% increase in revenue. So we're aiming for a 1.1 million in revenue this year. Our cost of sales we've worked out to be 43%, 42%. Therefore, our gross profit in this instance is 58%. We've got our list of overhead expenses, including an owner salary in there. You'll note that. And then we've got a net profit dropout at the bottom. So in this instance, we're aiming for a 15% net profit, which equates to 167,000. So this is something I'd encourage you all to do if you don't have one of these in place. This is really important in terms of goal setting and then monitoring against it, that you have a 12-month budget in place that we then track against, and ideally hit or exceed this at the end of the year. So we'll move on. We've still got a bit to get through. So knowing your key profit drivers. So understanding what are the profit drivers in your business. This is a list of what they are. Obviously, price is a big driver of profit. So the higher the price obviously adds to your margin, but that will largely be dictated by your market and your competitors and what your customers are willing to pay. So that's more typically a tool, a driver that we can influence in high touch businesses. So high levels of service, differentiation, where we can justify a premium price. Or if you're more of a low touch, more volume type business where there's lots of competition and your customers are more price sensitive, then volume is probably going to be the more metric that you go after, and focusing on volume rather than price. Obviously, our costs are a key driver as well in managing those, which we've covered, variable and fixed. The cost of debt's there as well and managing that. Inventory and WIP management is another big one. So obviously, if you're a product business, you carry inventory. So that's key in your business as a product business to manage your inventory, manage it well, ideally turn it over as quickly as you can, buy as low as you can, sell as high as you can, and making the margin on that is obviously key in product business. WIP refers to work in progress. So that's more relevant to service-based businesses where you're completing services for clients and managing your WIP and basically charging on time there. And then another big one to be mindful of is scope creep. So obviously with service-based businesses, making sure that what you're actually charging equates to what you're actually delivering. And very often there's a skew there, and that's where profitability can be heavily impacted. If you quote a client $10,000 in work for a year, and it actually you actually spend $15,000 in time on that client, but you only recoup 10, then that has a significant impact, obviously, on your profitability. So managing scope creep is really, really important, and tracking against that to make sure that you're on track there. And then, how we actually express those can be as a dollar figure, a number, or a percentage. But the key is really understanding what's most relevant for you, and then let's drill into that and have a look at how we can then make changes and use that to drive our profitability. Here's some non-financial profit drivers, which first one there, capacity planning and productivity, again, is a big one in a service-based business. and talking to a client last week who's in digital marketing. They haven't been getting the results that they would have liked, and spending a little bit of time talking into it and talking about his business and drilling down. His underlying issue is his team's productivity. He thought, and the data he was getting indicated that they were at the or just below the productivity level. I think it was 70% was their productivity target. But when you drilled into individual team members, he had a couple of poor performing team members at 50 and below, and he was picking it up, being 100% plus productivity, because he was working hard and putting in extra hours, but he was just monitoring the high level team productivity without drilling into the detail. And that's basically the reason for his lack of profitability in that instance. He needs to get the team, those individuals, more productive, and if you can't, reassess those individuals and those team members. But he's basically got a business that should be doing $1 million in revenue. It's only doing 800,000 based on his team, but the cost structure, he should be doing $1 million, and that 200,000 is the profit that he's not making that he should be effectively. So some other drivers, non-financial drivers there listed, obviously client satisfaction, quality, training, etc. So I won't spend too much time on those. The next one is how to achieve your profit goal. So if we've set our profit goal, how do we then actually go about working towards it? What changes can we look to make? So firstly, really important, and not so relevant for everybody, but it's important to understand, and it's a reasonably quick exercise to do, is know what your break even is. And it's particularly important in growing businesses to know what you at least need to be doing to break even as you grow. That this is a bare minimum figure that you need to be hitting in terms of revenue. So it's a pretty easy calculation. If you follow these steps, it'll give you the answer. But if you have a look at what are your annual fixed costs, you can work out if it's 10 grand a month, 120 grand a year, what is your average sale per job or client? Then what is your average gross profit margin per job? So again, if you don't know that figure, you'd have to do the work on that to work that out first before you can do this exercise. Then you simply divide the fixed expenses, so your $100,000 in costs, divide it by your average gross profit at 5. Therefore, you need to be doing 20 jobs at $10,000 is your average cost. So your revenue would need to be $200,000 in this instance to break even. So if you've got fixed costs of 100, your gross profit margin is 50%, you need to be doing 200K, excuse me, 200K in revenue simply to break even. So again, just useful to know, really. And then you can obviously, we don't want to be breaking even, but ideally well above that. And again, this re-emphasised, I think we've probably covered it largely, the impact of margin in terms of from a break-even perspective as well. In this instance, a builder, again, between 25 to 15% margin. At 25% to break even, he needs to be doing 1.1 million. If he's at 15, he needs to be doing 1.9. So the next one is then knowing what your minimum viable sales is for your profit goal. So it's a similar calculation to your break even, but it's not just to break even, it's to hit our profit target. What do we actually need to do to work out? So again, a pretty simple calculation. What are your fixed costs? What is your profit goal? What is your margin? What do you need to be doing to hit that profit? So it's at a high level, what level of revenue do you need to be doing to hit that level of profit? So in this case, it's the same figures, $100,000 in fixed costs. We've got a profit goal of 100. We've got a 50% gross profit margin. Therefore, we need to be doing $400,000 in revenue to achieve a profit of 100,000 based on these numbers. Then obviously we'd spend more time, we'd drill into the detail around, okay, well, that's all good and well. We've got a $400,000 revenue target, but where's that going to come from? What's the breakup in terms of clients, in terms of services, and then do more work on analysing that. So this is really at a high level. And then how to achieve it. So again, this is drilling into a little bit more detail, but having a look at a more granular level in terms of number of customers, average number of transactions, average value, and then working out how many customers do you need to get to that level, and then doing some more work out of that. But again, this is just an indication of what you need to be doing to achieve your minimum profit target, so that you know what you're going after as a top line figure. And then the next one I wanted to cover off is capacity analysis. And it's a big one as well in terms of understanding what is the capacity in your business. And again, it goes back to the client I was talking to last week, the digital marketing agency, understanding what their capacity is. And when we did the work on this, which again, it's not a complicated calculation and they already had the data, but it's basically working out if you're and this is a service-based business, that what should each team member be expected to generate in terms of revenue. And there might be different ways you can calculate it, but one way is an hourly rate and a productive percentage to then multiply it through essentially and work out how much revenue should each team member be generating. Obviously add them up, that gives you your total capacity. Then you compare that to obviously current clients, current revenue, and how does that look? And this is really important in terms of growth when you've got to take on new team members. How much capacity do you have now? How much will you need based on what your projected increase in growth is to be? So this is another really useful exercise if you're not already doing it as a service-based business, particularly as well. Okay, so next one, increasing sales and revenue. So it's not so much a financial discussion. This is obviously more a sales and marketing discussion, really, in terms of if we say we want to go and hit X amount of revenue, it's then having a look at what's your marketing and your sales strategy to achieve that. But obviously at a high level, these are obviously some of the things that you can look to do to increase your sales. Obviously productivity, which we just covered, getting more out of your existing team, developing new product lines, finding new customers, new markets, increasing your prices, giving discounts to increase your volume, etc. So a number of strategies there that you can look at. Again, we won't spend a lot of time here because it really is more a marketing, a sales discussion than financial so much. Next one, obviously reduce our costs. So when we're talking about profitability and just seeing how we're going time-wise, decrease costs. So effective cost management, what can we do? If you're an inventory-based business, tight management of inventory and really spending time on how do you manage your inventory? How do you finance it? What is your inventory turnover? How quickly is it coming in and going out? Do you have stale inventory that you're sitting on for a long time? So that's obviously really important in product-based businesses. Other types of costs, direct and indirect costs, overheads as well, which we've largely covered. And then also we'd have a look at benchmarking in terms of where do you sit with your expenses compared to where you should be. And from an overhead perspective as well, and drilling into that and understanding where we should be and where we're at. And sometimes you're carrying too much, sometimes you're not carrying enough, and that might be restricting your growth potentially. If you're really running too lean. So again, that's really something unique to your business that we need to drill into. And then the last point here, really, in terms of other ways to improve profitability. So this is always an interesting one that I really enjoy having discussions around is within your business, are you trying to be everything to everybody? Or are you focusing on a particular segment, a particular service, a particular client base or product? And I always equate it to doctors and generalists versus specialists. We all know who charges the highest rates, the most premium, the hardest to see. That's the specialists. Why is that? Because they're the best at one thing. They pick a particular area and they're the expert. They're the go-to people. People will pay a premium for it. They'll wait to see you, etc., etc. So I think it's a real key consideration that a lot of small business owners particularly get into the trap of trying to be everything to everybody, trying to cast the net too wide, service too many different types of clients, offer too many different types of products. And that has a direct impact on your profitability because your costs do increase disproportionately as you increase your services. And this example with the lawn guy started out just mowing lawns, obviously just needs a lawnmower and an edge trimmer to do that. But then he started getting into gutter cleaning and roofing and chimney and needs a whole bunch of other tools. And he doesn't do it all the time, so he's not as effective, not as efficient, etc. So I just really encourage you to have a think with your business. Where do you sit? What are you providing? And who are your customers? And if it's too wide and too broad, then I'd suggest revisiting it because it's more than likely impacting your profitability. And can you pick one area that you really enjoy, you're passionate about, that's your sweet spot, go after that. And it makes life so much easier from a marketing perspective as well, if you're really clear on who you want to work with and what you want to do for them, you can really go after them and be the specialist or the expert for them, and finding that sweet spot. Then you can charge the premium, you can increase your price, increase your margin, you get better at delivering that service because you're just focusing on one particular segment. So I think really encouraging you to, and that can be a huge one from a profitability perspective. And then the next one, which kind of ties into that, I suppose, is sacking some clients and customers that aren't the right fit for you, that are negative from a time and an energy perspective, negative from a team perspective, negative probably from a profitability perspective. Yes, it may be a short-term hit on your revenue and your ego maybe, but long-term, it's probably possibly the right decision to let them go, focus on the right clients, the right work you want to be doing. And, if you've gone down some paths where you're doing work for certain clients or industries or products that deep down you probably shouldn't be doing, then just pull the pin. It'll free up your time, free up your energy, free up your resources to go after, what you should be doing and where you add more value. And then obviously how we go about that is important. Do it graciously, off-board clients, find them another home ideally, or have another solution for them. Don't just leave them in the lurch. Obviously it's the right way to go about it. A couple of other things here I really encourage. The first one, if you're not up to date with your bookkeeping and have accurate bookkeeping, that's number one for you. You've really got to get on top of that to be actively managing your finances and know where you sit. You've got to have up-to-date and accurate bookkeeping, and at a bare minimum monthly, so that you can at least be running a monthly report, but ideally more regularly than that, so you're on top of it. Make it a priority. Two metrics in there: customer lifetime value, customer acquisition cost are two things, particularly if you've got a bit of marketing and sales expenditure. If you don't know those terms or don't know what they are or how to calculate them, or you've never looked at them, highly suggest you look at those, because they will help you inform your marketing spend and your marketing decisions, and will help you understand what return you're getting on your investment from a marketing and a growth perspective, knowing what does it cost you to acquire a customer, what is that customer worth to you over their lifetime, and is that relationship, is the cost to bring them in worth what they're actually worth to you? And if they're not, then you need to reassess. You're obviously doing the wrong, going down the wrong path in terms of marketing. And it'll also help inform your marketing spend in terms of different channels. So, if you work that number out, you might find that your Facebook advertising is much more cost effective than SEO or digital marketing or AdWords or whatever it might be. But that's really useful exercise to drill into. Capacity and productivity, we've pretty much covered. Weekly key metric monitoring. So again, a key takeaway is understanding what is the biggest pain point for you, the biggest issue. And I'd suggest focusing in on that, making that your priority, and having a metric to then measure and track against that to get on top of. So, and it does vary from business to business, so it's a bit hard to give one metric for everybody. If I was, it would definitely be gross profit margin. That would be the main one, but there can be other ones, depending on your business. Where is your business pain point? What is the main issue that you need to spend time on? And then, set a metric that then helps you stay accountable and track to it. This is a quick checklist. Again, I won't go into too much detail. We're pretty much out of time, but this is what I'd really encourage you to all be doing. So take a screenshot of it, or we can certainly send you a copy. Just a bit of a guide in terms of what you should be doing and how regularly you should be doing it from a financial management perspective, and will really help get you on track to make sure that you are managing your finances, taking responsibility, and then working on turning things around ideally and improving your bottom line. So we're almost there. We're out of time. Quickly to wrap up, just encourage you that really, if you want to see change, you've got to change. You've got to do something differently. So if you're not getting the results that you're hoping for, then something's got to change. You've got to do something differently. And the great man here, Mr. Einstein, said that if you keep doing that and you expect a different result, then he calls it insanity. So just encourage you that make time for it, put some time into it, and make it a priority, make some change and implement. So some quick tips: make it happen, implement, get some help. Talk to your accountant, talk to your bookkeeper, involve them. If the cash management internet banking helps to put money aside, hide those accounts, move them to a different bank account, etc. Check in with your accountant to get better accurate figures around your tax and your GST and your super, so you can better plan for that. And key takeaways. So again, I think we've pretty much covered this, but know your key metric and focus on it, and create that focus, create that discipline to make that change. Yeah, profit's not an event, it's a habit. What is the perfect size for your business? I think the answer is it will happen naturally. And a quote that I like is, a business will never outgrow its founder and leadership, really. So that's something to be mindful, which leadership is a whole nother discussion, but to be mindful as well. And then ideally aim to be the world's best in one spot, in one thing, your sweet spot. And I've got there, change is hard, and it's like a new diet or fitness regime, always harder and will be harder before it gets better, but also not changing is hard as well. So pick which hard you want to go down. I think that's pretty much it. So yeah, just really encourage you, have some action items, go away and implement and do them, make it happen. And then ideally I'm seeing this time next year that you've turned that profit around and hitting your target, or ideally smashing it. So that's pretty much it. So just to quickly wrap up, if anyone's wanting some more help or wanting to have a further chat to see if I can provide you any more guidance, we're offering a free 15-minute strategy call around your profitability, so we can dive into your numbers, have a bit more of a discussion around your specific business and your circumstances. So I'd love to have a chat with as many of you as possible to see if we can help. So if you'd like to do that, the link's there on our website, book in for a call. And yeah, we'd love to chat to see if we can help and make some impact in your business and your situation. Otherwise, that's pretty much it. So we'll open up for questions. If anybody's got any questions, feel free to, I don't know, you might be able to unmute yourself. Otherwise, pop them in the chat. Or any thoughts or feedback from anybody? Anybody got any particular takeaways or highlights from that they'd like to share?
Good job, Mark. That was awesome. We loved it. Great tips, gold. I think it just made us $1 million. No.
Hopefully.
Well done.
Good. Thanks, Colin. Thanks, Lauren. Appreciate it. All right. Well, if there's no questions, no other feedback, thanks everyone for your time. Sorry we've gone a little bit over. I do value all your time. Appreciate you taking the time out of your day and your lunch break. Hopefully you got something from it. Yeah, please do reach out if we can help in any other way. And hopefully speak to you all at some point soon. Thanks, everyone. See you.
Thank you.